future viewer will be enjoying this film for posterity on YouTube once Luke posts it. So, come to the third session, maybe the end for now, but probably, hopefully not the end for forever. As I said in the note to everybody, I'm happy to continue these. I really love doing these with you guys, and I feel like, even if it's an intimate group like 3 like we have today, or sometimes we have larger groups, it's time well spent. So, last time, as you'll recall, we through the blocks of the financial system, financial institutions. We talked about financial statements and how they work. And in the last session, we would get into further completing the portions of the analysis we had around financial ratios, and we would start talking about actual financial modeling and how to think about that. Now, I think in some cases this may be a refresher, and in some cases, it'll be maybe a little bit newer material for some of you who are watching this on film. So I'll try to hit kind of a middle of the road for everybody. So let's remind ourselves as a quick refresh of last time what we had looked at. So to practice one more time, we have sec.gov if we want to find financial filings. A nice picture here. They advocate. We go to filings and go to company filing search. We picked Oracle last time, very good memory, and so we'll pick IBM today just to do a different one. We go through the tree and try to find, IBM, you're crafty. Okay, this is actually good. This is a good learning moment too. So oftentimes a company will have an acronym and you have to put it by its actual name. So we'll put International Business Machines. It's so hard, IBM. All right, we can put it by ticker. Let's try that. Fast search. We'll put it over here. So if you're looking by name, that's a way to do it, but then if you're getting a little bit frustrated and the company's listed, you can go fast search. Okay,
I think it was there when you first pulled up IBM.
Oh,
I think so.
My site's clear. So a reminder, we can look through the filing types. The most common ones are 10K annual, 10Q quarterly, 8K for pertinent and important information. So put in 10K. We go IBM's annual report. We'll do this all faster than we did last time. We look at the list of documents that are here. And the first one is where we want to start, and there can be some interesting exhibits and other information in the back, particularly if the company's complex. In the front of the document, we find general information about the company and their core business, which goes into risks and the management discussion of results. As you go further and further back on the document, there's other information. So as you can see here, in fact, so they have, in fact, split their financials. So another good learning moment. So you see that here, IBM's actually put it in a different section. If we go back, we can often locate it by just looking for the other big portion of the document, which seems to be here. And this is their financials. And in fact, this is everything. Good. So they generally have an overview of the financials up front. In DNA, they have other statements of risks and various things and some discussion of their performance. If we go down, find the actual financial statements because they come right after the audit letter. So PricewaterhouseCoopers, that's the auditor's letter, and financial statements. So, make this a little smaller because the screen cuts off a little. And for our financial statements, again, as a refresher, the statement of earnings or the income statement is a statement over a period of time, not a snapshot. We start at revenue, which is often broken down. If business sells something that has direct costs, we have the direct costs, which subtract that out. The direct cost or COGS gets us to gross profit. We have costs, which classic ones are SG&A or selling general and administrative expenses, research and development, and other related expenses. Subtracting that out gets us to the operating income for the company. Then we take out income taxes, and sometimes there are other things like loss or gains from minority operations or discontinued operations. That gets us to net income. We have shares, which can be basic or diluted shares, which include the effect of things like convertible stock or stock options, and then we get the EPS for the company. And generally speaking, on the bottom, they'll tell us all the shares. So a refresher on the income statement. I will pause between each of these, but I know we went over them last time, so I won't stop that long. Questions. We go to the balance sheet again. The balance sheet, as we remember, has assets on one side, liabilities and equity on the other side. We have all current assets from top to bottom. The class ones are cash and relatively equivalent cash securities. We have things like accounts receivable, which is money that's supposed to come in, prepaid expenses. We have long-term assets, things like PP&E, and taxes and intangible assets and so forth. We add all that together and we get the total asset balance. A major one to remember is goodwill, which is basically a fill for any type of asset balance of the company in this representation and capital value that we can't represent in something else. That's how you make the company whole in terms of how they're capitalized. On the other side, you have liabilities and equity. You have current liabilities, things like short-term debt, accounts payable, and so forth. Long-term liability, which is mostly long-term debt, obligations that the company has to its employees, and other types of deferred income. You generally have shares broken down between common stock and the actual value of the company when it was actually capitalized or it had secondary offerings. And then you have, on top of that, retained earnings, which is basically a representation of the net earnings that the company has generated as an ongoing concern. You add together the liabilities and equity, those equal the assets, and you have total liabilities and equity balancing out the assets. Finally, you have the cash flow. Divided into three parts. You have operating, investing, and financing. You start with net income for the operating and have depreciation and amortization and some other things. You have all the changes related to assets and liabilities changing on the balance sheet, and that gets you operating activities. The net income, so the cash flow statement reconciles with the other two statements in two important ways. Net income, which is at the top of operating cash flows, matches back to the income statement. In the middle, you have investing, which is primarily PP&E and other purchases and disposition of property, plant, and equipment, and effects you have on intangible assets. So that's the middle, investing activities. And on the bottom, you have discretionary activities as well. So investing and financing are discretionary, which makes them separate from operating, which are things like proceeds and pay downs of debt, stock purchases and pay downs. You add all three together and add it to the starting cash position in addition to changes because of exchange rates. That takes your beginning cash balance and changes it into your ending cash balance. The ending cash balance then reconciles back to the balance sheet. So those are the two ways that the cash flow statement reconciles against the other two statements. So those three integrated financial statements is a quick 5-10-minute refresher. We're all good. Okay. So then, just as a reminder, there's a whole bunch of stuff in the back of the financials in terms of footnotes, which can be very valuable and useful information. But we're going to skip off of that, and we're going to go to ratios now. So last time, and here we start our new content, you remember what we talked about is, when we started our discussion, where we started the second session is, we said, what is corporate finance? And we said, although there are many definitions, I offered one potential definition, which is basically two main disciplines. One is study and understanding of the capitalizations of firms and why and how they reach and make the decisions to get to the capitalizations that they have and or raising the capital that they have. And the second part is how we as managers, analysts, people in organizations, decision makers, analytical and decision-making tools to take that information about the company and use it to be more informed and make decisions related to that company or entity. So, a pretty thorough job together looking at how capitalization occurs, what it is, how we define it, how we look at it on financial statements. Today is based entirely on that second part of the equation, which is basically how do we use analysis and our understanding of that data to make better decisions about, understand, and articulate what we do with that information. So we're going to do this in two parts today. The first part is we're going to talk about financial ratios. So we're going to go through the we can use numerical values found on the company's financial statements to gain meaningful information about the company. And again, people divide them in different ways, and on purpose, each dive looked at this, chosen a different site just to show you how ubiquitous this information is. And it's not like there's one site I give that you have to bookmark or something. This stuff is everywhere. Chosen the Corporate Finance Institute this time, which I randomly picked by Googling, although that is in fact a pretty good site. And you'll see that down by ratios around liquidity, we'll talk what that is, leverage, growth, margins, profitability, rate of returns, and valuation. They may have a few others at the bottom. So let's go through each of these and talk about them, and we'll try to time it to is 2:20. So what we'll do today is I'm going to do about 4. I'll stop a little bit early just because something came up that I have to do on the back end, but we'll do these 2 hours. I'll try to spend, I don't know, 20, 30 minutes on this. We'll finish earlier, end up going a little bit late. We'll spend an hour doing the financial discussions, and then, in fact, I'll volunteer this right now, in maybe 2 weeks from now, set up a session right now, Alex, to have a 4th session, and for that 4th session, maybe the last thing before you go, you can set up a 4th session so we can continue the discussion with the 4th session being, and for everybody listening on recording, the 4th can be finishing financial modeling, because there'll be a lot I know I can't cover today, and taking any questions about anything related to finance, accounting, financial systems, anything we discussed. And then from that 4th session, we can figure where to go.
We might want either Megan or you or Luke to set it up, just because I don't know if I'm going to have my Veeam email still. So, you know what I mean? I could still call in on another email, but I don't know if I'll be able to set it up.
Totally fine, totally fine. Can you just let Luke know everything I said about the 4th session and put it with him? Thanks, my man. And make sure that whatever it is and when it is, you're there. Shakira style, whenever, wherever Alex Lando and me can be together, okay? So we have to do that. Okay, so good. So, perfect. Okay, so let's get down to business here. So, liquidity first. So some of these, there's going to be a little review of what we did last time, right? So what do we talk about when we're talking about liquidity ratios? What we're talking about is ways that if we look at a company, and the key point that you should remember in all these is the word comparability, right? It's interesting to look at this in a vacuum for the company itself because there are general rules that we can come up with. What's even more interesting is if I take 3, 4, 5, 10 companies in the same sector and I look at the same ratios for each of them, what can I glean from how relatively strong or weak that company is to others? And what's also interesting is if you do stuff like this, what you find over time is it's a really handy way to just do it. You're going to like chuckle a little, but really to just do this like for fun. Like I remember when I was learning this stuff, I would just sit down and pick like 30 companies and just run through the ratios because you can an awful lot about how different industries function. So I'll give you an example. You'll find that in something like retail, the current ratio will be pretty low because companies often run pretty lean, they don't have very high margins, stuff like that, versus something in like financial institutions where you're generally going to find that banks are very well capitalized most of the time. Of course, sometimes they're not, and we've had some tough moments in our country's history, but because that's like a big part of how they run their business. Or if you're Caterpillar and you have tractors and all kinds of stuff, you're going to have higher ratios. So that's interesting. So current ratio, we discussed last time. So the current ratio is take the current asset position of the company and divide it by the current liability position of the company. The idea is that since you're taking all the assets and liabilities that basically have a 1-year life or shorter, it's giving you a good measure of, within a reasonable amount of time, how capitalized is the company and how could it find itself in a position to pay off or address its short-term liabilities. The test or quick test or quick ratio. Some people define the test or quick test quick ratio is different. They don't have quick ratio on this one, so I'll pull that up. Just so you can see it. Making the PDF page better, although again there are many. So it was here yesterday. It can be called the quick ratio or the acid test ratio one measure, which is here, is current assets less inventories over current liabilities. So the idea is you're making it like even more punitive, right? So you're trying to say, if I take out all of your inventories and just measuring stuff that, you know, I think has saleable value. The reason the asset takes out inventories is, think about it this way. Imagine your TJX, to go back to TJX over and over again, and you have $100 worth of t-shirts that say, you know, Kiss rules on them, right? Inventory, it varies, but inventory much of the time does not have the same value, and if a company was actually in distress, it often has fire sale value versus its book value. Another measure of the quick ratio is this one that is here, which is taking cash and equivalents plus marketable securities plus accounts receivable. The reason you see both of these, I would traditionally call the top one the asset test ratio and call the bottom one the quick ratio, is because the first one is an asset test, and if you get rid of the stuff that's not really convertible, what would it be? The second one is basically saying, if you take the stuff that's only most quickly convertible to cash. So cash and marketable securities basically your cash. And accounts receivable, unless the company that you're collecting from is insolvent, you can probably convert most of that to cash too. So that's one more of thinking of it. It's basically like cash and equivalents plus divided current liabilities. Okay? And I'll do this last one, and then we'll pause in each section to just see if there are any questions. The cash ratio is a variation of the quick ratio. So if the quick ratio, the true quick ratio, is cash and equivalents and accounts receivable, this takes out the accounts receivable and literally is saying only take stuff that's cash or that you can immediately convert to cash and divide that by current liability. So again, the liquidity ratios give you a measure of a company's capitalization in the sense of its ability to immediately retire or less obligations. Any questions on that section? Oh, are they over here? I beg your pardon. The operating cash flow ratio 2, which is operating cash flow over current liabilities. So the idea here again is this is not the cash, but it's cash generation in one period. So this would be probably most interesting if you were looking at it on an annual basis. It wouldn't be that interesting if you were looking at it in a 10Q. Cool. Let's do leverage ratio. So the idea in the leverage ratio is you're trying to see, and it's funny, isn't it, right? You could basically take that phrase that I said, like, what does this say about the company's capitalization, right? It's not called capitalism for nothing, right? Everything in corporate finance comes back to capitalization. So, say, how much debt does a company have? And based upon that debt, should we be concerned about that level of debt or the company's ability to pay off that debt, either in the form of debt or interest payments that come up relative to their assets or equity? So that ratio says, if you take a company's total liabilities and divide it by its total assets, what ratio do you get? Now, this is going to, again, vary by industry, but I would be concerned if a company's ratio of total liabilities over total assets became more than like 2 to 1, something like that. There's some industries where you can break those rules for various reasons that we won't get in today, but you know, it's a measure of how much debt the company is relatively borrowed compared to asset balance. And in fact, these with other more complex analysis are what a lot of agencies like Moody's and S&P use when they come up with their letter ratings for bonds. So if you get in bad shape with these ratios, eventually you're going to get downgraded, and then it becomes a slippery slope because it costs you more money to borrow because you don't have as good of a debt rating. The equity ratio takes a similar idea, but instead of taking total liabilities over total assets, it says total liabilities over shareholders' equity. So an interesting idea with this is it's also trying to say basically how much equity generation have you been able to get out of your liability structure. Let me close that. Look. I don't need your rewards. All right. So that's the equity ratio. The interest coverage ratio is trying to say similar variant of operating cash flow ratio. They're very similar. It's to say if you take the company's annual operating income and divide it by its interest expenses, what is that ratio? Now, why is that interesting? Because debt doesn't do it once, right? Some debt does, right? Sometimes there are notes that have interest payments. The interest on debt is typically paid twice a year, and then typically a balloon payment where you pay back your principal at the end of the life of the debt. This basically says that on a day-to-day basis, this is why things like the footnotes are important, because you can look in the debt and actually find out when that principal is due. This is how easily is the company able to cover those annual or biannual payments of interest given its annual income that's coming in. So the interest starting to drag you down. You'll also find that for different industries, people often have sophisticated calculations of what amount of your total expense should be interest. If like 20% of the expenses that your company pays is interest-related expenses, that's obviously not good. And for service, now we're taking the operating income and we're not dividing it just by the interest expenses, we're dividing it by all of the total debt service. So some people interpret this in different ways. Sometimes total debt service will be when the principal comes due on notes. Sometimes, remember when we would analyze a company, we would maybe amortize the debt. So let's say the company owes $100 a year in interest, and at the end of 10 years it owes $1,000. We would take the $1,000 with time value of money, which we'll discuss later. But for now, for sake of argument, let's say you divide the principal by 10 and just say it's 100. You would say, well, okay, kind of. The company has to really pay $200 a year if you amortize that over time. So that's total debt service. Efficiency ratios. Oh, sorry, let me pause there for a second. Okay, efficiency ratios. So the efficiency ratios, this is giving us a sense of for assets that a company has, types, how well is it putting those assets to use in generating profit or turnover for the company. So the asset turnover ratio says net sales or revenue of the company and divide it by its total assets. So the idea here is if 1,000 in total assets, you should be able to generate that amount of money in terms of sales every year. Not in all industries. Again, there are some industries that are heavily capitalized, so you can't quite hit that ratio. But if someone's generating $1 in sales for every dollar in total assets, and someone else is generating $2 in sales for every dollar in total assets, they're much more efficient in the amount of sales they're able to generate off of their asset base. A similar idea for businesses that have a retail component of inventory is look at how efficient the company is at turning over its inventory. So a classic thing to look at for, again, a retail store, not grocery stores, because they have a built-in element of groceries thawing and expiring and so forth. But for things that have physical goods, you can look at the cost of goods sold divided by the average inventory, with the idea being in any given period is the company turning over its entire inventory. The better the ratio is, the company is at inventory. And if you think about this in terms of tangible expenses, if a company is better at managing its inventory turnover, that's not only going to be good for sales, but it's going to cause lower expenses, because if you carry less inventory, you need less physical space to store the goods. So that's less money, and holding costs can be very expensive. Receivables ratio, look at how quickly you convert your receivables into cash. So it looks at the total sales that you make for credit, and it divides it by the average accounts receivable. So are people in your business, are they paying you every 30 days? Are they paying you every 60 days? Are they paying you every 90 days? The quicker that you can convert into, obviously the better. Now, that's going to clearly be different by industries. You know, if you're Boeing and you're selling airplanes, Boeing has very long terms of sale because people are paying them tens, hundreds of millions, billions of dollars for airplanes, versus if someone goes to CVS. And see someone's receivables turnover ratio is very poor, that's to become a leading indicator that potentially a lot of those receivables are going to end up being potentially bad receivables and may even need to be written off. Day sales and inventory ratio. So what this says is, if you take the year and you divide it by the inventory turnover ratio, this is another way, it's an inverse of it's a slightly different idea from inventory turnover, but the idea is this is how you can calculate how many days your inventory ends up being held. So again, obviously, the lower it is, the better. Wait, questions? So profitability ratios. Profitability ratios, these are the most traditional ratios that people who know ratios generally know for analysis. So most of these are performance and either measuring it by another measure of performance or measuring it by some measure of capitalization. So some quick ones are margin analysis, right? So you can divide gross profit by sales, operating income by sales, EBITDA by sales, and get a relative measure of your operating efficiency to your sales level. Less ones, but also very valuable ones, are return on assets and return on equity. So in these, you take net income in both ratios, and in one case, you divide it by total assets, and in the other one, you divide it by shareholders' equity. What this is trying to tell us is, on a relative basis, for every dollar of equity or assets, how efficient is the company at generating profitability? Okay, those ones are pretty clear. For market value ratios, these are pretty obvious, and I think most people know these cold, but I'll go through the one that's least used, which is the book value per share. So remember how we said the value of the company in terms of what you see on the financial statements is not equal to the company's value in the stock market. Stock market value is equal to the total shares outstanding. If you take this fraction here and we have shareholders' equity on the left, if you take the company's market capitalization and you divide that by total shares outstanding, that's the company's market trading price. Take the shareholders' equity and you divide by total shares outstanding, you get the book value per share. So what's interesting is you can determine the premium of market over book value that the market is assigning to a stock. So it's a good test of how reasonably valued a stock is. So this becomes harder and harder to do with all the information that's out there. But when valuation investing started, and Warren Buffett, for example, was making his name, one of the things that he would always say is he would never make an acquisition of something that he couldn't buy for book value per share or close to that, because he only wanted to buy something that was fairly valued. That's, for example, he never bought anything in technology, and he buys boring things like, suppose Coca-Cola is exciting in its own way, but he puts stakes in Coca-Cola, and he buys companies that make, textiles and, stuff like that, because those companies tend to not have overvaluation. The dividend yield is just the dividend per share divided by the share price, pretty straightforward. Earnings share is just the earnings divided by shares outstanding, pretty straightforward. And the P ratio is the share per price divided by the earnings per share, pretty straightforward. So a nice overview of just some financial ratios. If you get into it, there are a million books, references, sites on that type of thing. Some have like 100 ratios, but these are some pretty common ones that can be effective. And starting to line up these types of comparisons can be pretty interesting for understanding how companies work and their values. Any thoughts before we rotate to modeling? Okay, cool, that was fun. And now, funky. So, is long form version of my Excel training book. So, Did I say, yeah, break off Excel, go to SEC.gov to read statements together. We did that. We did reading and understanding financial statements, so you know how to do that. Oh, we need to do one more thing, which is we need to talk about comparables and multiples. So, what is this all about? So, if we think about financial metrics and how we value companies, I will suggest to you the concept of, this is an old one from like my first week of work in 2004. Oh my God, I'm getting old. Okay, so when you do a standard banking analysis, the idea is that you create what's called a football field analysis. So we're going to work backwards here. So the football field analysis at its best is, and its worst is your boss an opportunity to get to the number that they want somehow. Being ridiculous. At best, the idea is that it gives you a wide range of valuations in order to not have one outlying one that skews your thinking, but also to see if you're starting to get consensus around one specific value. So, there are many different ways to value a company, and I'll talk a little bit about each of them, and we'll go back and talk about comparables and precedent transactions in a second. So, when you do your football field analysis, the first thing that people often look at is, I've listed a few of them here, but I'll go through the whole list just to show you the general concept. The first one is comparable analysis. So comparable analysis is, let's take a simple one, and we'll look at some more in a second. And I look at every company that sells groceries. I look at every company that sells groceries, and I take the ratio of their revenue over their assets. Let's say I look at 20 companies, and the ratio of revenue to assets is 2.0. Now I look at our company that we're trying to value, and the company has 1,000 in assets. So the company has 1,000 in assets. I could take that value, and I'll show you how, and you could basically convert that valuation into some type of relative ratio measurement of its value compared to other competitors. So that's comparable analysis. We'll cover that in a second. In transactions is, you don't even look at where the company's trading, you look at deals that were made. So let's say you're looking at in the chemicals industry, and you again pull a list of 20 transactions, and all 20 of those companies were purchased for 1 times their revenue. Again, if you have a company that has 1,000 in revenue, that would imply that if someone was to buy that transaction at a valuation similar to other companies like that, its present transaction value would be 1,000. The remainder of these are so DCF and M&A model. Those are somewhat trickier ones, which we'll go through, which are basically these models really kind of sum and bring together all the strands of financial analysis and corporate finance, because they get to the heart of how do you value companies. And either of these models basically value things through one of 2 ways. They either value things through some manipulation of the company's cash flows and their ability to generate cash, or it values them based upon using the concept of precedent transactions, where you value the company in terms of some multiple of some metric, whether it's revenue, EBITDA, net income, something like that. So that's a football field, basically taking a number of those different analyses, having ranges based upon an assumption or 2 in each of them, and coming basically with a line somewhere that says, okay, well, I have these, I'm going to also apply judgment, the valuation 60. Okay? Any questions on that?
So traditionally, you have to hit all of them for it to be, like, where would you?
It's a very good question. I mean,
or does it just depend on what the person wants to value?
Kind of. I mean, it's a little bit loosey-goosey. I mean, what happens is, the way I would say is it really depends upon the audience, right, and what the goal is. So I'll give you 2 different examples that answer your question. That's what you just said is like really at the heart of what would make these things so effective, but also so tricky to use well, right? So, if you're in like investment banking or some type of financial advisory or consulting service, I would argue that the way this is used is, usually a client will come to the person and have some sense of what they think their company's worth. They've already looked at some tables, they looked at some analysis, and then you look at it for them, and you try to, it usually ends up being that you're trying to substantiate or refute what they already have in their mind. So let's say the guy comes to you and he's like, I think my company's worth 100. You say, no, it's not. What is more typical, though, is if someone comes to you with a chart like this, they think their company's worth like 70. And then what ends up happening is the question is, well, are they right or are they not? And what ends up being the nuance is, and the real difficult part is, these techniques are easy, right? Anybody could run these with a computer. When someone provides value, which does happen from time to time, it's all the nuance of how you determine it. So let's say we looked at supermarkets and we were looking at supermarkets, and you were a place Star or Shaw Market in New England. So now there are all kinds of questions. Do I compare myself to Trader Joe's? Do I compare myself to Whole Foods? Do I compare myself to supermarkets like us in the Midwest, like Kroger? And so like where the magic happens is, what is just the right comparable for what this organization actually is or aspires to be? On the other side of it, if you're Zach and Ratmir and you're going out looking for companies, I used to say elephant hunting, which is actually what Warren Buffett does. My wife loves elephants and goes to Africa, so she's like, you can't use that term anymore. So if you're going out treasure hunting, how about that? Elephants too. If you're going out treasure hunting and you're actually in a company looking outwards, the way that this would often go is you use it to set like a bargain hunting ratio for yourself. So if the side motion is, the guy comes in and he's like, I'm worth 70, and you're trying to kind of talk them off the cliff down to a reasonable valuation where you think you can get a good sale. Other people on the buying side of it go in the other direction. So if like Ratmir's looking for a company and instead of what's here, this was companies in, networking, or I don't know, some aspect of business that we thought would be helpful to our business, if they think this is the fair range roughly for companies, they would probably draw a line at 50 and say to themselves, well, we're really going to look for a bargain for companies that are down here. And or, if I'm buying something above here at a premium, it better really be something really interesting and differentiated that is worth paying such a big premium over market valuation. Okay. So, now let's pick apart the aspects of the football field. Okay, so let's talk about, financial metrics. So, to quickly put this in context here of what it means. So, precedent transactions is pretty straightforward, but some of it can have a little bit of nuance that I think is worth refreshing our minds on together. So, EBITDA, as a reminder, take operating income and add back depreciation and amortization. The idea behind that, again, is companies make larger or smaller capital expenditures to invest in their business. And the idea in adding back the D&A, which is the gradual expensing of capital expenditure over time, is we do not penalize one company versus another for making a more aggressive decision to invest in their business. EBITDA is one of the most common metrics that's used for company valuation, and I'll tell you why. Because revenue is top line and does not have a reflection of the company's expense structure. On the other hand, net income is often not used because net income includes measures of operations that are not based in core operations. It includes things like interest payments, it includes non-operating expenses and income. So I think a lot of people land on EBITDA because it reflects top line, it reflects bottom line, it doesn't reflect extraneous non-operational expenses, and it normalizes for investment decisions. So that's why I would argue EBITDA is like the king of valuation metrics, which is why it's used in so many things. In terms of enterprise value, this is a concept we haven't mentioned at all yet. So again, I argue the king of if this is the king of operating valuation metrics, this is the king of capitalization valuation metrics. So, capitalization is pretty straightforward. You take a company, now again, this is not book valuation, this is market valuation. If a company's private, that's a little bit more difficult to come up with, but we'll put for a future session. Let's assume this is a public company. You company shares times its price, now market cap. You take the equity value to get the enterprise value, you take the equity value, you add the company's total debt, and you subtract the company's total cash. Now let me explain why you do that. The reason you do that is, if you go back and you think about equity, debt, and cash. Equity, debt, and cash. It's kind of like a proxy for the balance sheet, right? So the balance sheet has the assets on one side and the liability and equity on the other side. So what you're doing is, you're basically incorporating all the capitalization aspects of the balance sheet. So you're taking their equity, adding their debt, and subtracting their cash. Now, because of this, interestingly, enterprise value is higher if a company has more debt. So, an implicit assumption in a company that has a lot of debt as part of their enterprise valuation is, this is why the ratios are important, is you've done your homework that, like, the debt represents value because the company used it to capitalize, but you have to be sure that they're not going to, like, go bankrupt because of the debt problem. So, like, a classic example of this is, before the auto bailout, many of the auto companies had very high enterprise values, but a big reason for that wasn't their market cap. Actually, auto companies, surprisingly, despite having so many employees and so much value, very rarely capitalized based upon equity. They capitalized based upon debt. So they would have, $20 billion in equity, and they would have hundreds of billions of dollars in debt. So they would show a very big enterprise value, but that enterprise value kind of had Swiss cheese holes in it because they were very exposed to liquidity. Does that make sense? Enterprise value.
There's one of the ratios is debt to equity.
Yeah.
You use that to see if the enterprise value is not, but of how healthy the company is.
Yes. Very good. So you would use that. That's a perfect one. That's actually, I like that even better than what I was going to say. So debt to equity is a great way of testing enterprise value. Another one, which is a little bit like more boring, is you can also test liquidity by doing like net income over interest expense, right, and that type of stuff from that perspective. But from a valuation perspective, that's even better. Nice. Okay, so perfect. So now we have tools. So we have the operating metrics. We have capitalization metrics. So now, imaginary universe of companies which ended up buying one another. So A bought F, B bought G, and so forth. You can see here that what we listed for each is what was the transaction value, what revenue, and what was the EBITDA, right? And so you assume when you say transaction value, what you're really saying is you're saying enterprise value. And let's think through why that is. So if Corporation is a hot show on the block, and I want to buy them, she has equity value of 500 in market cap. She has 200 in debt, 100 in cash. Okay. If I want to buy her, I have to buy all the debt because those debt holders are owed money, and I own those debt obligations. Buy all her equity. Now, I don't have to. I technically buy 50% of an operating stake, but the 51%, but this is easy to explain with 100%. So I pay her $700. Thank you very much. I now own her company, but she had 100 in cash. So that 100 in cash is now mine. I can use that to retire the other obligations. So I paid $600 to buy her company. So enterprise value and transaction value are the same. my precedent transaction tree. So I simply take the transaction value, this metric, TEV over revenue, and divide by revenue. For E over EBITDA, I take the transaction value and I divide by EBITDA. I go all the way down the table, and now I get some values. And this is literally what people do in banking, right? So they make the precedent transaction table. They probably don't do it for 5 deals. They probably do it for like 30. But then they do all those transactions. Part of it is, any deal that you would be looking at, unless it's in a really obscure industry, you potentially, hundreds of transactions that you could pick, which ones matter and which ones are applicable, right? Another example, I'll give you one last one before we move off of this, is the art is even in which industry you use. So when I was doing one project once, we were looking at a company called Hologic, which worked in cancer. Specifically, they did a lot of stuff in breast cancer and imaging. And so the interesting thing was, if you looked at the nuts and bolts of what they did in their business, a lot of their business looked a lot like imaging companies that didn't do anything in healthcare at all, but worked in photography and digital imaging. So what ended up being part of the concept tree was, they looked a lot more like those companies than other companies that were working in cancer. So sometimes getting the right valuation, it's like a nice test of how well you really understand the business and what the company's doing. Any questions on this? Okay, so that's in transactions. That's one thing you put on your football field. Then
work backwards that you're trying to sell. Do you just figure out a multiplier that you want?
Yes. So what would happen is well, everyone's obviously gaming it to get the highest valuation they can. So yeah, you would look at the valuations that other companies had. Now, what's interesting is, I have to explain this. So what is happening is, there's been a disconnect between these different valuations for a reason I'll explain. So, what things like DCF modeling, again, all of these are at their best if you're doing them correctly. DCF modeling and things like that, and M&A models, which we'll explore in a moment, they're what I like to call bottoms-up models, because you're taking underlying financials and you're using them to construct a business-based valuation of an organization or a business. Things like transactions and comparables are top-down models, because taking a valuation someone's already ascribed to an organization and you're implying the same valuation to your organization. When people are selling their companies, usually what happens is, you go without seeing this many times in your careers, right? When people buy companies, you often hear they bought it with like a 30-40% premium. And like, why in the world do they pay such like a huge premium? Amir, you told me there's book value, all this crap. Like, why are they? What's up with the premiums? So what ends up happening is there's often a large disconnect between the DCF modeling, the bottoms up, and the precedent transactions, the top down. So what ends up happening is, like, imagine in this case, right? Not this is going to happen for a long time, if at all, but like Andre and Ratmir have worked so hard to build up this business, right? Justifiably, they should have an expectation that whatever the book value is of their business, if they ever were to sell somebody or somebody else in the future after they retire, they wouldn't sell the business unless it was at a premium to what the book value is. What usually ends up happening is, if you do the DCF modeling exercise, again, this can be games, but if you're doing it correctly, usually the DCF modeling comes at the lower end of the football field analysis, and precedent transaction ends up being at the higher end of the analysis, because what people ask for is a premium above what they think the fair value is. So that's why, and that's what's fun and kind of interesting, is that teases out a range and now you figure out where to go. So that, anyway, the short answer to your question is, if someone's selling their business, they would probably do a bottoms-up analysis, apply a premium of what they think is fair for their time and for the inherent value of the business, and that would probably probably be close to the precedent transaction.
Okay.
Cool. Okay. Or now, we'll talk comparable analysis. So the idea here is, the idea here is I've set up three hypothetical companies, company A, company B, and company C. Now, each of these organizations, you see that they're underlying metrics, right, for like revenue, EBITDA, net income, and so forth. This is like the precedent transactions, except nobody's buying anything, right? So, again, on the spectrum of the football field, if transactions are higher because they have this implicit idea of a premium that people are expecting, this is somewhere in the middle or on the lower side, along with DC modeling and that kind of stuff. So, the idea is you set the business, you down their stats, you put down shares so you can calculate the market cap, you put net debt, so net would be debt minus cash, so that reflects basically both components in one. You would add the market cap to the net debt to get the enterprise value. Now you have everything you need along the operating metrics. So you put down the revenue by year, you put the EBITDA by year, and the net income. So now on one side you have the capitalization metrics, and on one side you have all your operating metrics. So then, is you divide through and all your metrics. So you have, enterprise value over revenue, over EBITDA, and then the equity, you need to make sure not to have a mismatch. So enterprise value ties to revenue and EBITDA. Net income actually considers everything, so net income goes with equity. So the nice thing of doing this by year is, since a few different years, 16, 17, etc., you can make sure that the analysis isn't contaminated by having like 1 year of particularly high or particularly low operating results. Oh, also, that I have a concept of LTM. So what does LTM mean? LTM is last 12 months. So the idea with LTM is, let me get a marker here, is that let's say, I can do it on the computer so people can see the cast. So the idea with LTM is, it's the middle of the year, and it's like July 10th, right? So it's July 10th, and the company closed their year 12/31/17, and we're looking at revenue now. Let's say the company had 100 in revenue for ended 12/31/17. Let's say the 6 months ended June 2018. The company had 50 in revenue. For the 6 months ended June 30th, 2017, a year before that, the company in revenue. So now, if I said to you, what revenue for 2017 to June 30th, 2018, what to do in order to calculate this, which is the LTM is, you would take the previous year plus the current year period minus last year period equals the LTM. So in this case, what that would mean is, take last year's revenue, which was 100, you add the 50, which is from the 2 quarters of this year, subtract the 20 from the 2 quarters of last year. So what you've done is, instead of your annual number, this is why it's so important to use the 10Ks and the 10Qs, you basically constructed a 4-quarter number that is the most recent 4-quarter period. So exciting. We'll do it one more time with Megan. So the LTM, the basic idea is, you know, the year's number, which in this case, let's say it's currently July 10th. And what's the most applicable financial metric? Well, you wouldn't just take the last 10K because that's 7 months old. The most recent metric is June 30th, 2018. So you would take the revenue number from the last 10K of 100. You would add the 6 months most recent. So this would be from January 1st to June 30th. Let's say that was 50. You subtract the 6 months period from a year prior to that, which is 20, and you would basically add the annual number plus current 6 months most recent minus the 6 months from a year ago, and you basically have constructed what the 4-quarter number is, which is cool because now you don't need that number. You can make it yourself based upon the company K's and Q's. I haven't said that they should construct the LTM number for you. It would be really easy for them to do it. You know, Q's financial people, and so what are you going to do? So that's the LTM number. So anyway, all we were saying, Megan, was the comparable analysis was like a transaction, except the deal hasn't happened. So we have market cap, we have our net debt, you make your enterprise value, and you pick up all your metrics for revenue, EBITDA, and net income. Now we know what LTM is, and let's say in this case we have the numbers for 16 and for 17. Now you have that, so 1 year of skewed results wouldn't skew the data. And now you just divide through. So LTM revenue, you would take enterprise value divided by, from the previous page, sorry, by the LTM revenue, you get that ratio. You divide all by these metrics that were on the last tab, and you get all these ratios. You would divide the market cap, the stock price to get the PEs, and then you have these, again, if it was in a bank or a PE firm or whatever, you would have 30 of these. You take the high, the mean, the median, and the low. And typically you would take the median because the median ignores outliers, right? And you would get that. So part 1 of your football field, excuse me, would be precedent transactions. Part 2 of your football field would be comparable analysis. Some people call it AVP, or analysis at various prices. That's part 2. But we get into part 3. So things get a bit trickier. So we'll take a piece at a time. So I would argue this is the of like this is the Cadillac of corporate finance models. Every other thing in corporate finance, whether it's doing an LBO model, private equity firm, whether it's an M&A model, whether it's doing derivatives modeling, which of course gets a little more interesting because you have calculus and stuff like that, but all of that stuff is based upon being able to do a discounted cash flow model and understanding the concept of discounted cash flow, work average cost of capital, and able to combine them together. So let's take this one piece at a time. Good, 50 minutes. So, benefit, I know you guys know this, but for the benefit of anyone who might not know this, who should not feel uncomfortable at all, because learning always starts somewhere, to talk about the concept of discounting, right? So the idea is, if I am generating cash flow in my business, and the current year is year 0, I'm going to start monitoring my business. So I'm looking at the business over 5 years, 6 years if you like. Every year, if I generate 100 in cash flow, in reality, not book level, but in reality, the sum of the cash flows that I've generated over this period of time is 600. But that's not true because in deployment of capital always has an opportunity cost. So, you look at a capital project, an investment, anything in finance, right? Buying a house, whatever you like, basically saying to yourself, I could do two things. I do this project, or I could go to Vegas. No, I could do this project, or I could hypothetically take money that I would put into this project and I would invest it in something else. The question is, what is that something else? Some places call this the working average cost of capital. In corporations, it's more popularly sometimes called a hurdle rate, and companies use hurdle rates to see whether a project makes sense. So, what it is, let's say, hypothetically, let's say we were in a situation where there were other projects going on at Veeam. Me and Andre and Peter felt comfortable that if they had $6 invested in other parts of our business and generate a 15% return a year. And there are various ways you can come up with that. We'll do that in a second. But let's say it's just true. What you do is take a discount factor, which we're going to do here manually once to solve together. So in the first year, the discounting factor would be 1.15, because if we divide 100 by 1.15, we get 7. That is the value of 100 in the first year, because if they took it and they invested it somewhere else, they know that they could get 15%. So you have to meet or beat that to exceed the cost capital deployment somewhere else. Every year that passes, that discount rate compounds because another year has passed. So in this case, in the second year, I'm going to knock this down. Year, the same value as on the top, and I'm going to just do it here to emphasize the point. You know what? You can be my friend. Okay. Now, the other way of thinking about this discount factor is, that in each year, it's that value to the power of whatever number of years have passed. So, in this year, it's 1.15 to the 1 power, then 0.15 squared, and so forth. Now, if that's a high rate, now that is a very high hurdle rate. I think you would find that in most companies in a low interest environment like this, right? And I'll explain why a low interest environment in a second. You would expect that a hurdle rate would be probably high single digits to maybe like 10, something like that. I think when we were at EMC, maybe the hurdle rate was, I thought that was a little bit aggressive. But anyway, so now you can take each of these values and in each year, you can divide it by the cumulative discount rate. Oops, sorry, 100 divided by the discount rate. Now, very different story, right? So the 600 that we had a nominal value, actually only 378 if you discount it. So whenever someone says to you, you know, what is money worth and what's the return, this is the compounding, which is why in a similar way, right, everyone always invest early. Again, everybody knows this, but is that similarly, if you or say a 10% return, which is not crazy, this point, if you invest in each year, depending upon when you invested, if you invested starting balance, earnings, ending balance. The correct way to do the computation would be, take the 1,000, multiply by the rate of return, which is 1.1 divided by 1. Whoops. So let me use the mouse. Then the starting balance would be equal to the ending balance. It's similar to what we saw above. The value of gaining $100 each year is in fact not $1,600, it's $1,771, right? So anyway, that's everything on discounting. Now, let's here. So build this up piece by piece. So the first thing I want to talk about is the working average cost of capital. So these often have hurdle rates that they draw as a premium on top of this, and then a lot of math and complicated statistics. But the idea is that people who observe the motions of capital over time were to determine a rate that is a theoretical of what cost of capital determination should be. So the way you calculate a cost of capital is second. So I did this correctly. Okay, so the way that you calculate the weighted average cost of capital is, the idea is that you are blending together, again, you can say we were going back to the capital structure again, right? Because that's everything in corporate finance. The idea is you're taking various rates related to company's capital structure and using those to the company's cost basis is. The first thing that you do is you take a look at the company and do this based upon book value. So you take the company's total debt, you take the company's shareholders' equity, and you together. What percentage of the debt plus the equity, the debt piece? So let's make an example. Let's say that the company's weighted debt was 30, equity was 70. The total amount of non-asset capitalization on that side of the balance sheet ledger is 100. Debt portion is 30%. Obviously, the equity portion is 70%. The reason we do this is we're going to calculate a cost of debt and a cost of equity, and we're relatively building up the capitalization to reflect the underlying capitalization of the company. For the cost of debt, what you do is you take your cost of debt comparable to what the company's borrowing costs traditionally are. So, for example, a good trick is if a company, based on its bond rating, was to go to market and try to borrow a 10-year note, how much would it cost them to do that? That's pretty easy to do. Line to, let's see, let's try Bloomberg. Cost of debt by rating. I used to have a page bookmark for this. Debt costs. Let's see here. You kidding? Where's the link for this? All right, let's try cost of debt incorporating. I'm having. Hold on here. I want you to. Aha. I think this Our table for this. Fine. Anyway, point is, it's easier to find these rates. There are many pages that have these. I'm just putting in ad queries probably today because I'm sleepy. But if you look at the rates here, the same way that you see the bills, right? So when we arrange notes, are arranged by maturity and what they represent, right? So government notes and bills have names and bonds have notes depending upon their tenure. So it used to be when interest costs were higher, the government would also release 20 years, but they don't anymore. And government debt obligation from the federal government less than a year is referred to as a bill. So there are 1, 3, and 6 month bills. Anything that is less than a 20 or 30 year tenure is known as a note. So there's 1, 2, 3, 5, 7, and 10. And then your bonds. And see here, we can find the public rate of what the yields are on these federal treasury notes. There are, of course, also state bonds and municipal bonds, which are exempt from certain forms of taxation, but of greatest interest to us for the exercise are two things. One, the 10-year note, which is also sometimes called the risk-free rate. The idea is that amount of money where you're borrowing from the United States government on a 10-year note, so it has both a measure of length to it, and it seems basically being a completely safe investment, at least for now. Who knows what this country will be like in 20 years. On the other side of it, you have corporate debt. So corporate debt, higher borrowing costs, right? Because this is the government, right? So when you have corporate rates, basically, these are the tables of bond ratings. So these Standard & Poor's and Fitch's have ratings for debt. They take S&P as an example. S&P and Fitch's are very similar. Moody's has always had a slightly different system. But they start AAA and basically go down. Triple B minus or below, you'll see on the right that it says investment grade and non-investment grade. The less polite name for non-investment grade is it's called junk bonds. The idea is every tier that you are here in this table, the lower you go, the higher you pay for borrowing costs. In this economy, which is a very strong, healthy, robust economy, borrowing junk debt for a corporate borrower could easily put you into interest costs of 9–10% a year. And, corporate debt, I'm guessing now, but based upon, typically where the market's at, I think 6–7% is unusual for someone who has like an A rating, a reasonable mid-rate A rating, maybe 6s. Anyway, keep those numbers in your mind, which we'll put here. The cost of debt that you would get from looking at the underlying cost of debt for a company like that, given its debt rating. You have a company's risk-free rate. You could take a 10-year note. You could take a 30-year bond. I usually take a 10-year, especially if you're in a healthy interest environment. You have your cost of debt, which we talked about. And your tax rate, which I'll explain in a moment. The tax rate that you put in is let me put little notes next to these as we go, because I know I'm throwing a lot of information out there. So this is the risk-free rate is 10-year note. That is, take the company's debt rating and find their borrowing rate. If you best case, you could also look at their footnotes to cross-check and see if that's actually what they've been borrowing at, because you get a list of debt in the footnotes. Sorry, that's here. The debt would be, look at companies' debt and shareholders' equity, balance sheet, and find ratio. That's what you do for the equity. tax rate, you look at the company's tax rate on income. So you take what's called the company's statutory rate, which is what they actually pay in taxes. Variables, which are a little bit trickier, are take the company's beta. So beta is determinable. So beta is basically a measure of this thing you can simply look up. The site where you put in the ticker of the stock will give you the beta. Again, this is more difficult for private companies, but we'll assume it's a public one. You look up the beta, which is it's a relative measure of how much the company's stock price moves relative to an underlying index measure, typically the S&P 500. So if a company's beta is 1.2, what that means is if company stock if the S&P 500 goes up 1, the company stock goes up 1.2. If the company stock goes down 1, the S&P 500 goes down 1, the company stock goes down 1.2. It goes both ways. And it is very important. This is one of the foundational parts of the Black-Scholes model, which is one of the foundations of basically derivatives and that type of stuff. So anyway, that's the P is the equity risk premium. So what the equity risk premium is, and actually sites that calculate this too, but there's a little bit into more advanced finance, but you can just take my word on it for a second, is calculate this. I'll tell you what the idea is, and then now you calculate it. The idea of the equity risk premium is I have a concept of a market rate of return, right? So that's what that's the base market rate is. So let's say the S&P 500 has been going up. I usually look over 10 years. So, and there are ways to do this. But one easy way is look index for 10 years. S&P 500 is a good one. Next, the stock in question. What was the difference in return? So, if you last 10 years and the S&P 500 was up 7%, you look at the stock in question and it was up 10%, the equity risk premium would be 3%. If the company has a longer horizon and you can do it for like 30 years, all the better. Some people will be like, forget this, I'm just going to assume some reasonable number, because typically the equity risk premium is not, no company long term can outperform the market by more than 5, 6, 7%. So I would say usually you get a value here that's 3, 4, 5, 6, 7, something like that. Maybe if it's a high flying tech stock, that would be a little bit different. Okay. So now all the building blocks, and now you put it all together. So next you take, for the cost of equity, what is, you take the risk-free rate, which again was that rate we got from Treasury notes. I'll tell you what you do, and then I'll explain why you do it. You have the beta times the equity risk premium. So the idea is that what you get in terms of a blended return in terms of a cost of equity is you could basically a resting base rate, and the resting base rate would be in addition to what you could get from the market risk premium. So what it's saying is, instead of the market rate of return, right, let's say the market rate of return is 8%. That's not guaranteed. The stock market has very high volatility. However, if market risk premium is 5%, you typically outperform the market by 5%. So instead of the market, the proxy for the market is the risk-free rate, because the idea is you can get that no matter what, and then you would earn some premium over that, okay? So you do that to get KE, or the cost of equity. We know because we just put it in. We look at the company's costs. Now put it all together to calculate the WACC, or the working average cost of capital. So what you do is you take the following. You take the company's cost of debt, you multiply it by the weight of the debt, which in this case is 30%, and multiply that by 1 minus the tax rate, because the company is insulated from that for cost calculation. You have to insulated. You take that out from the cost of debt because the company has to pay taxes on it, so it's going to lower the rate. Forgive me. Add that to the equity times weight of equity. The weight of equity and the weight of debt add to 100%. You've now created a blended cost of capital, and I'll blow this out just so you see it's not 7% like that. That's just a coincidence. It's a very specific number here. But that gets you to the weighted average cost of capital. So, in line with what we did here, if now this was a capital project and we actually wanted to know what the cost was, it's not 1.15. It's actually 1.7 and change. Now, we in fact okay, so now 1.7 in there. So in fact, before we super crude assumption because we didn't know what it was, but it turns out actually, based upon the weighted average cost of capital, if the value was 100 a year, it would be 476, not 600. That's the weighted average cost of capital. And using that weighted average cost of capital, a pure mathematical way of determining the discounting rate, but again, keeping in mind the concept that some companies will use that as a baseline and have some hurdle rate because they don't really believe the weighted average cost of capital. But if you're in a future job and someone's asking you to discount a project, you should always say to yourself, well, shouldn't we use the WACC? And if the WACC then says 8, and they're like, no, our hurdle rate here is 12, you should, well, okay, that's very nice, but like if the hurdle rate is 12, me put in something into the WACC that gets us to 12. I'm not just using 12, like tell me why you think it's 12. Is it because our cost of debt is higher? In most cases, what they're really saying when they say that use 12 is they're probably saying that they think the company's equity risk premium is higher than you're saying it is. But you should make them defend that. I know a lot. Any questions on all of that? Okay, good. That's a pretty tricky one. That's one of the foundational concepts. Still have an hour. Awesome. Okay. All right. So now, back to the DCF, and we'll have that be the last thing we do. And next we'll hit the heavy stuff like MA and LBO modeling. Okay. So now, we know how to calculate a WACC, and we have a WACC, and we're going to put together a discounted cash flow model. This is the most traditional old school way of valuing a company over time. So there's a lot of moving parts to this, so we'll take it a step at a time. So first, we are going to put together everything that we learned from looking at financial statements. So we start with the company's revenue, right? Most companies don't report bookings or billings. Even if they do, you start with revenue because you're looking at recognizable revenue over time. So in this case, I set up a new amount to start with, and then I'm going to guess. Oops. There we go. So we put here a guess at what we think the growth rate is over time. So it's multiplied through and some amount of revenue growing over time. Now, here is you have to put in, because there are two ways of doing a discounted cash flow. We're going to do both. There's what's called the multiple method, and there's what's called the perpetuity growth model. Put that for a second. The perpetuity growth model relies on a very important component, which is how much do you think the company is going to grow in perpetuity? So, usually what you use for the terminal growth rate is you use a value generally in line with GDP. Because the idea is, at some rate, unless your company's going to take over the world, unless you're Amazon or whatever, right? You're never going to grow at a faster rate than the market, or than the underlying economy in the long term. So typically people use some number between 2 and 4, like during the boom around the 90s and the aughts, who were like, the rules are changing, man. Like, we're going to grow at 5 or 6% forever. And I was like, whatever, man. Like, peace and love. But, like, it's 2 to 4%, you know? So I usually go with 2 to 4%. I've even put 2 here to be conservative. Okay. Next. We're a product that has direct expenses. So we've assumed some percentage for COGS. So basically I put in COGS at 40% across the board. Make it nice and simple. Subtract the COGS out of revenue. That gets us to gross profit margin. Actually, technically say gross profit, not the margin. Very good. Next, I assume a flat percentage for OPEX. So I said operating expenses or indirect expenses were 20% or $20. So we take that out of the gross profit. So now we have 60. And you know it's growing over time because the revenue is growing. We got 20% op margin. So now the number us to EBITDA. Then I'm going to take the depreciation and amortization out of the EBITDA. Sorry, I did this correctly. We get the EBITDA, and then I'm going to take the D&A out of the EBITDA in order to get to EBIT. So I'm assuming in this scenario that we have depreciation and amortization. Take out the D&A, and that's to operating income. Now, the EBITDA will come back later, as with the D&A. But there's one more concept here, and then the rest of it is putting stuff together, and that's the concept of free cash flow. What does free cash flow mean, and how do we use it? The idea of free cash flow is remember, we looked at flow statement. The part of the cash flow statement, if you recall, with net income, made a number of adjustments end up at operating cash flow. This is free cash flow, and it's not cash flow is. We're assuming that all that other stuff that happens under operating cash flow is not happening anymore. And the only cash flow that we're concerned with only effects that we're concerned with are things that affect operations. So, EBIT, because we're also not concerned with all the other stuff that happens below the operating income line. So all that stuff around, like, you know, interest and income from other entities and so forth, we don't care about that. We care about income that is generated from the operation of this company. So, the thing that you do is you take out taxes, because the only thing that you know for sure is you have to pay taxes. That's not an operational decision that you can make. So an assumption for the tax rate, I think we got 35% down here, so I use that again. You attach the spreadsheet to the email, or did I? I think I did. Okay, hold on a second. That's okay. Before I forget. Cool. Okay, so without, that's a little there, I guess. Okay, so you take out taxes. Next, D is a bookkeeping number and not a real figure. So we add back depreciation and amortization. Out of order, we take out any CapEx that we want to assume, because again, CapEx is a choice. We're taking out D&A, we're taking out CapEx. That's not, unless you're a construction company, buying equipment is not a core part of your business. And the final adjustment that we make is we take into account changes in working capital. So, and this is a complex thing in and of itself, but basically if you remember in the, let me pull it up here, then jumping around, so please do ask any questions. If we go to filings, you remember our cash flow statement. The construct of the cash flow statement was net income. There's some adjustments for D&A, and then there's a section called changes in operating assets and liabilities. The deal with this is you adjust the cash flow for changes in working capital, but you shouldn't be penalized in your, or you have to make for the adjustments. So like if your accounts receivable went down, it means that your cash went up. So you have to reflect this because this isn't a normal part of operations, but these changes in the balance sheet are representative of changes in cash. So, to recap, because I know I threw out a lot there. EBITDA is relatively straightforward. You COGS and you take out OPEX. You get to EBITDA, you take out the D&A to get to EBIT. Now, you take EBIT and you take out taxes because you have to pay taxes. Now, you take out all the changes in discretionary spend or balance sheet items that basically should be reflected in free cash flow as a modification of operations. You adjust for D&A and CapEx because those are discretionary choices, and you adjust for changes in operating and working capital because even though those are balance sheet changes, they have implications for cash. You put all of that together, and you get cash flow per year. And your perpetuity cash flow, you take the last year of cash flow that you had and multiply it by one more growth rate of the terminal rate. So 2. As we discussed over there, all these caps have to be discounted, so we discounted these by the working average cost of capital, which we just calculated together. So end up with a set of discounted cash flows, that sum up to $69, okay? Now how you do the valuation based upon the methods. I'll take out of order because the terminal value method is a little bit more straightforward. The terminal value method is take your EBITDA in the year. So I go here, you look at the EBITDA and grew it at the terminal growth rate. The EBITDA on our terminal year was $52, or 51, which is what it was in the 6th year, grown forward by 1 year. That EBITDA, you multiply it by the EV over EBITDA multiple. So if you go back to the comparable tables that we did, you would look at a whole bunch of companies and look at their enterprise value over their EBITDA, take the median or something like that, and you would get a multiple. You would multiply that by the EBITDA, and you would get an implied terminal Now, sorry, let's ignore that for 1 second. Then, you want to use the other method, which is the terminal value growth model. You would take the free cash flow, which we calculated here in the terminal year, 16. What you do is divide it by the WACC minus the perpetuity growth rate. So we calculated the WACC here, that was 7%. We assumed the perpetuity growth rate up here, that was 2%. And the idea is that basically you're assuming that's the rate at which your company would grow forever. So growing at the implied growth rate of the weighted average cost of capital less the perpetuity growth rate. Next, I just an average of those two. So 324 and 260. So the value is 292. I brought the value back to the present value of the terminal value. So if I took the average terminal value, which is 292, the other question becomes, if someone was like, how much cash would I give you to be worth the terminal value of the business? If I give you $200 today, that would be worth the terminal value of the business in the long term. You do DF and a weighted average cost of capital. Any questions? I know that was a lot of stuff. Okay, cool. So, what that I have here, mini model gets pretty tricky. All right, so this is for the next time in that channel. Cool. So thank you guys. I really appreciate it. So we covered, to recap for everybody, we reviewed financials, we looked at financial ratios, we did a football field analysis, and we talked about comparables, multiples, precedent transactions, how to do a DCF model, how to calculate the weighted average cost of capital. So you know how to do basically everything that a banker does, except for a M&A model and a LBO model. M&A model, which I'll talk about for a minute, but we won't go through today, not so different from some of this other stuff, but basically the idea is you're jamming together two companies plus other stuff. So you basically determine the two companies' financials, you add them together, you figure out how company A is buying company B. If company A, this is like a tease for next time, I guess. If company A buys company B with stock, whatever amount of stock they have to issue, well, that's going to go in the denominator and it's going to dilute the company's value. If company A buys company B with debt, whatever amount of money that they can't cover in cash, they're going to have to issue debt. So that's going to increase the enterprise value because debt's going to go up, and there are going to be implications for what the company owes in terms of ongoing interest. The last piece is, if you're in a company for $50 million that's worth $50 million book value and you're buying it for $100, you take the remainder of what's called that fair market value, and the similar idea, like how you depreciate an asset that you buy, you amortize the value of that company purchase over time. That's basically what it is, and you know there are fees that you have to pay to people and all kinds of stuff, but that's the general idea of what an M&A model looks like. The LBO model is the most complicated because now you're combining a buyout with DCF. Because basically you're buying a company, you have to understand what that means for the underlying financials, and also in terms of the discounted cash flow, you have to understand, because you're borrowing an enormous amount of debt to buy the company, if there's enough free cash flow in the underlying company, so in 5 to 7 years when you exit the deal, you can pay all the debt off, and then whatever's left goes into your pocket as equity. So those are the other two models, but what we talked about today, plus those two things, Everything you need to work in corporate finance and valuation. See you, everybody, and let me see. Wow, you hung in there the entire way. You're an angel. How are you doing?
Sorry, I was trying to mute it. That was hot, but I'm good.
Well, that's it. Do you have any questions, Claire? I want to give you a chance. I mean, I know, there are angles of this that you could run circles around me on, but I hope that maybe there were a few interesting nuggets for you, too.
No, it's I have the background, but I don't use this stuff every day anymore. So it was a great tutorial. I appreciate it. Thank you.
Hey, to me coming from you. Thank you very much. Well, thank you. We'll stop the recording here. Thank you.